What if I told you that using just one simple metric, you could have earned nearly 4 times more than the S&P 500 over the past decade? This strategy is so simple, it almost feels silly. But who cares if it's silly? If it works and lets you laugh all the way to the bank. Let me show you what might be the best profitability metric ever created, how it works, and exactly how it could have led to massive outperformance. The metric I'm talking about is Return on Invested Capital, or ROIC for short. ROIC measures how efficiently a company turns the money it invests, both debt and equity, into profit. It's basically a score for how well a business uses its capital to create value. Let me explain it simply. Imagine you run a lemonade stand. You spend money on lemons, sugar, cups, and a table. That's your invested capital. Then you sell lemonade and make some profit. ROIC tells you how good you are at turning that invested money into more money. If you make a big profit compared to what you spent, your ROIC is high, which means your capital is working hard. If your profits are small, your ROIC is low, and your capital isn't pulling its weight. Pretty straightforward, right? Now, we know that high ROIC is good. Companies that efficiently turn capital into profit are usually quality businesses. But here's the question. Is there a specific ROIC level that actually leads to better stock performance? Is there a sweet spot that consistently beats the market? To find out, I analyzed 713 dividend-paying stocks, going all the way back to 2011. This group included both high yielders and low yielders, fast growers and mature stalwarts. For each year, I looked at their ROIC and their total returns. Then I tested a very simple strategy. Each year, I'd only buy the stocks whose ROIC from the previous year was above a certain threshold, say 5% or 10% or 20%, and so on, and hold them for 1 year. Then I'd repeat the process annually. I tested every threshold from 0% to 100% to see where the best results showed up. The test period ran from January 1st, 2012 through August 7, 2025. Let's set some benchmarks first. The S&P 500 total return over that same time was 549.6%, or a CAGR of 14.8%, a very strong bull market period. If you invested equally in all 713 stocks, your total return would have been 751%, or a CAGR of 17.1%, about 200% higher total return than the S&P. The median return, however, was lower, 13.6% CAGR, showing that a few strong performers pulled the average up. So clearly, some of the stocks in this group massively outperformed the rest. Starting with a 0% threshold, meaning we invest in all companies with positive ROIC, we get a 16.9% CAGR, slightly worse than the full dataset, so no alpha here. But at a 5% ROIC threshold, performance edges higher to a 17.2% CAGR. Barely an improvement, but it's progress. Now, as we keep raising the bar, something interesting happens. At a 6% ROIC, the total return jumps to 804%. At an 8% ROIC, it's 931%. At a 10% ROIC, we cross 1,000% total return. And at a 12% ROIC, we hit a total return of 1,145%, or about a 20.4% CAGR. That's our first real sweet spot. At this level, we're investing in roughly 172 stocks per year, excluding about 75% of the entire dataset, and earning about 5 percentage points of extra annual return compared to the S&P 500. But it gets better. When we raise the bar further to around 26% ROIC, total returns pass 1,300%, or a 21.5% CAGR. That's nearly triple the S&P 500's return. And then, at 37% ROIC, we hit the jackpot. This threshold delivered a 2,195% total return, or a CAGR just under 26%. That's nearly 4 times higher than the S&P 500 and 3 times better than the full dataset. At this level, only about 11 stocks per year made the cut, the top 1.5% of the group. After 37%, returns start to decline. At 38%, they fell slightly to 2,125%, and by a 47% ROIC, the total return had dropped to about 1,186%. Interestingly, there was a smaller second peak around 60% ROIC, but nothing surpassed the 37% level. So why do returns rise up to that 30 to 40% range, then fall afterward? There are a few likely reasons. Number one is sustainability. It's extremely hard for companies to sustain a ROIC above 40%. When profits get that high, competition floods in, eroding margins and bringing ROIC back down. Number two is reversion to the mean. Businesses with sky-high ROICs often experience temporary spikes. Maybe they sold a big asset or had a one-off margin boost, and those numbers don't last. And number three is concentration risk. As the ROIC thresholds rise, the portfolio shrinks dramatically. By a ROIC of 40%, we're down to just a handful of companies. One or two bad picks can move the whole portfolio's results. So the sweet spot, around 30 to 40% ROIC, seems to be the point where companies are very profitable, but still able to sustain that level of efficiency over time. Let's take a closer look at the 37% ROIC portfolio to see what made it tick. On average, it held about 11 stocks per year, with the lowest count being 5 in 2021 and the highest 17 in 2012. It outperformed the full dataset in 13 of 14 years, and the S&P 500 in 12 out of 14. And get this, it never had a negative year. In 2018, when the S&P fell by 4%, this portfolio gained 14%. And in 2022, when the S&P dropped 18%, the portfolio still managed a 1.6% gain. That's remarkable consistency for such a concentrated, rules-based strategy. In total, 52 unique stocks were included across the years, but only 3 made the cut every single year. Domino's Pizza with an average annual return of 24.7%, Novo Nordisk with an average return of 17.6%, and Winmark Corporation with an average return of 19.7%. Now, not every stock was a winner. 7 actually dragged on performance, and a dozen more only delivered modest gains. And because the portfolio refreshed every year, turnover was high, meaning there'd be some tax drag in real life. Even so, the results still crushed the market. So, what can we learn from all this? ROIC works. It's one of the most effective metrics for identifying high-quality businesses. Companies that use their capital efficiently tend to outperform. There's a sweet spot. Between a 30 and 40% ROIC seems to be where returns are maximized. High enough to show excellence, but low enough to be sustainable. Quality over quantity. The strategy favored a handful of lead companies, about 11 per year, proving that sometimes a small basket of great businesses beats broad diversification. And simple doesn't always mean naive. Even this ultra-basic approach, using one metric, produced impressive long-term results. If you invest in individual stocks, take a look at the ROIC for your current holdings. Chances are, your top performers have strong and consistent returns on invested capital. This was just the first step. My next project is to refine this strategy, to build a list of dividend-paying companies with high and sustainable ROIC that are poised to deliver above-average returns. If you want to follow along, you can sign up for my free newsletter. I'll be sharing updates and new datasets there first. You can also find all of the charts I shared today, as well as a list of the 22 companies with a ROIC above 37% as of August 2025 in the latest post. I'll link it below. If you enjoyed this content, please like the video, subscribe, and let me know in the comments what you think about using ROIC as an investing tool. Thank you for watching and see you next time.